When you retire, you'll likely draw income from several different sources. And today I'd like to talk about how those sources are taxed. We're going to talk about your tax-deferred accounts, your taxable accounts, your tax-free accounts, and Social Security. So your tax-deferred accounts, those are your IRAs, your 401ks, where you put money in. You didn't pay tax on it when it went in, and you haven't paid any tax on that yet. So when you pull money out of that, you're going to pay ordinary income tax on that distribution. And when you reach a certain age, you're going to have to start taking required minimum distributions. They want you to start paying tax on the money in that account at a certain point in time. Another bucket is your tax-free bucket. This is your Roth IRA, your Roth 401k, maybe you have a Roth 403b. That money went in tax paid. So as long as you're 59 and a half or older and you've had that account for at least 5 years, you can pull money out of that bucket with no further tax. The last bucket is your taxable bucket. The accounts in that bucket are your brokerage accounts that may have your stocks, your bonds, your mutual funds. When you sell an investment, in order to create a distribution, you're going to have to settle up on the tax on the gain, and you pay that at capital gains rates. Capital gains rate is a preferential tax rate, so it's a lower tax rate than your ordinary income tax rate, so that's a good thing. You may also have dividends on some of those investments, and if they are qualified dividends, they would also qualify for that preferential capital gains rate. Now, the last piece I want to talk about is Social Security, because taxation on Social Security can be a little bit confusing. It is a little bit different than everything else. It is based on provisional income. And provisional income is your modified adjusted gross income plus half of your Social Security income. And if that number is more than a certain threshold, then you'll pay tax on some of your Social Security income. If you're at the lower threshold, you're going to pay tax on as much as 50% of your Social Security income. And if you're at the upper threshold, on as much as 85% of your Social Security income. So the key then in retirement is to look at how can you blend your income from these different sources in order to minimize your tax this year, minimize the tax you're going to pay over your retirement years, and ensure that you keep more for yourself. If you're not sure how you can do that, reach out to me. I'd be happy to help you be on your best path for retirement.